Hey guys, John Paulamy here, Actionable Intelligence. And today I want to talk about the oil market and the fact that it's in a new bull market. I also want to show you how you can take advantage of this cyclical upturn in oil that I expect to last over the next couple of years, and which I believe is going to take oil well over $100 a barrel. Now, the first thing I want to do is talk about why the oil market's moving higher and the fact that I believe the oil price is going to move over $100 a barrel. And one of the main reasons is that in the previous 3 or 4 years when the oil price crashed, this oil price crash severely constricted the cash flows at just about every exploration and production company that's out there. So as their cash flows were constricted and shrunk, their ability to invest in new production was limited. They were focused on cash preservation, debt repayment, and just staying alive in many cases. The problem is that oil is a extractive industry, and for every barrel that you remove from the ground, you have to replace that barrel, or at some point you go out of business. The other reason that oil is heading for over $100 a barrel is that OPEC has cut production along with the Russians, and they are maintaining their discipline. This is something we haven't seen for many years. Typically what happens is the different members of OPEC go and cheat on their quotas. Well, we haven't seen that. And so what we've seen is oil inventories around the world have shrunk dramatically. Now, when we're talking about OPEC, we're really talking about Saudi Arabia. It's the biggest producer in OPEC. It is the king. It is calling the shots. And one of the things that the new sheik there wants to do, MEK, is have an IPO of Saudi Aramco. In order to maximize the return or the amount of money they get on the IPO, it certainly behooves Saudi Arabia to have a high oil price. This would maximize the amount of valuation that's placed on the IPO and would also mean higher amounts of money that they would take in from the IPO. It's just common sense. Another factor in why I think oil is going to be over $100 a barrel is the IEA, which is the International Energy Administration that does a lot of forecasting on supply and demand, has vastly underestimated world oil demand, especially in emerging markets. We're constantly seeing at least 1 million to 1.5 million barrels a day of increased demand every year. So the call on oil producers to produce more oil is constantly increasing, and this is a direct result of increased economic growth. Obviously, increased economic growth takes more energy, and being that oil is primarily a transportation fuel, the transportation of people and goods increases as economic activity increases, therefore oil demand increases. Pretty easy to understand. Another factor in why I think oil will be over $100 a barrel is that shale production in the U.S. has been vastly overestimated. Yes, it is increasing, but it's reaching its maximum apogee in my view. There are severe bottlenecks and constraints in shale increasing massively going forward. And those include pipeline takeaway capacity, labor, there's just not enough labor, frac sand supply, and many other factors that are leading to the ability of shale in West Texas to be increased significantly. Not only that, you still have massive declines in shale every year. I mean, in a lot of these shale wells, the production drops by 70% a year. So to increase the shale oil production, not only do you have to replace the depletion of these wells that's depleting by 70% in the first year, but you have to increase the amount of drilling to compensate for the depletion, plus to add to the increase for your production growth. So this is a tremendous amount of capital and resources that are necessary, and as I just said in the earlier factor, those constraints are being identified and are now exerting themselves on shale production. A big factor that's basically ignored by many people is the production collapse that continues to go on in Venezuela. And I have a chart of that later that I'll go into. And of course, the Iran nuclear deal, which was up on May 12th, and Trump saying that he's going to nix the deal, and what that means for oil production and oil exports from Iran. So here's an example or some facts here, an old chart that show the capital spending of the five major oil companies. And you can see that for the last 4 years, the amount of money being spent on capital spending has decreased by 50%. So as I stated earlier, oil being an extractive industry, if you're not investing in future production, at some point your production or your ability to produce ceases. So I think this is a contributing factor. This is just an example of 5 large oil companies. It doesn't encompass the entire oil industry, but this is what we've seen across the entire oil industry, not only with the international oil companies in the United States and in Europe, but also the state-run oil companies like Petrobras and the Angolan state oil company and various other state oil companies. They just have not been able to invest necessary capital to maintain or increase production. Many of these state-run oil companies are nothing but sources of money for social spending and welfare spending in the respective countries. So there's competing needs for the money that's being thrown off, the cash flow that's being thrown off from the producing assets. If it's not going back into new production at some point, that's a problem for supply. As I said earlier, with the OPEC cutbacks and the depletion that's going on, we've seen the oil market come back into balance. Here's a chart of the oil inventories in the U.S. You can see that they're down almost 20% in 2018. You can see the decline from 2016. The market's now in balance and in slight moving into now negative territory, and that's what's causing the oil price to increase. Here's a chart. This is one of the opportunities I think is available in the oil market. This is a recent chart. The red line shows the price of West Texas Intermediate crude, and it shows the percentage increase since last December. It's about 25%. This chart's about a week old. Below that, you see the chart of the XOP, which is an ETF, which represents oil exploration and production companies. And you can see that for the last 6 months or so, or 3 or 4 months, I should say, the oil price has significantly outperformed the oil stocks. And that is not typical. As you can see to the left of the chart, typically the oil stocks correlate and follow very tightly with the oil price. So this variance represents an short-term opportunity. I believe that that gap will close. Now, it could be that the oil price declines and meets the oil stocks, or I suspect that because I think prices of oil are going higher over the next couple of years, the oil stocks will play catch-up. And in fact, over the last month or so, energy and oil equities have been some of the best performing areas in the stock market. However, I don't think the oil exploration and production companies are the best way to play this, and I'll go into that later. Here's a chart of oil demand, now showing that oil demand is exceeding supply. It shows the top line is the demand relative to forecast, and the supply relative to forecast is the orange line. So you can see that the forecasts have been wrong on both supply and demand. And we're now seeing the results of that as the oil price moves higher. Now, this is something that's not talked about in the media very much, but I think it's going to have a very big impact on oil prices going forward. This is a chart of Venezuelan crude oil production. And you see back in April 2017, Venezuela was producing about 2.2 million barrels a day of crude oil. This chart is a couple months old, but you can see over here, this is March of 2018, and production's down about 600 to 700,000 barrels. The forecasts and experts that I'm taking a look at are saying that it is conceivable that Venezuelan oil production could collapse below 1 million barrels a day by the end of 2018. That means another 500 to 600,000 barrels leaving the market. And in a tight market like we have, it's going to affect oil prices. And I don't think enough people are paying attention to this. I still think that most people are making the mistake, and this is in saying that the shale revolution, the shale lower for longer, shale being the swing producer, is the narrative. However, we are seeing cracks in that perception and that view as more and more people start to take a deeper look at what's affecting the oil price and the fact that we are now in a cyclical upturn. And typically these cyclical upturns in the price of oil go for 2, 3, 4 years. So we are the beginning stages, I believe, of the next upcycle in oil, which represents a tremendous opportunity. Now, the bottom line is oil is heading higher. There's less investment means less supply. Demand is relentless and grows every year. And the oil companies and the state oil companies must replace depleted resources. So every year, depletion is exerting itself on the resource. So let's say next year they're saying that world oil demand will be 100 million barrels a day. Well, within a year after that, you're only going to be able to supply 94 to 95 million barrels because you're depleting the resource as you're pumping it. So you have to replace that depletion, plus you have to produce additional oil to meet the increased demand. So basically, if you're talking 5 to 6% depletion per year, plus 1 to 1.5 million barrels of demand growth per year, you're talking anywhere from 6 to 7 million barrels a day of increased resource being needed to be found and put into production. That's the equivalent of a new Saudi Arabia every single year, and that simply has not been happening. So unless we have an economic downturn worldwide that curtails oil demand, or the oil price goes up sufficiently that it begins to destroy demand, we are going to see increased oil prices, and that represents an excellent opportunity for speculators and investors. I mean, oil is a cyclical business. It moves between extreme highs and lows, and that's just a factor of the long lead times in the ability of the oil market and the oil producers to respond to price incentives. I mean, people need to get it through their head that if you don't mine it or grow it, it doesn't exist. And you can't just sit down and drink 2 Monster drinks and work 24 hours straight and write an app to get more oil demand. It requires people to go out, do a tremendous amount of work. It takes a tremendous amount of capital and a tremendous amount of time. And this is only going to happen if the oil price is sustained at a high enough level that the oil companies begin to think that it is well within their while to go out and spend the kind of billions of dollars that are necessary. So eventually we will see those cash flows that are now building at these oil companies. If you've looked at some of the earnings reports of some of the oil companies, they're generating tremendous amounts of cash now at even at these current oil prices. And if the oil prices stay this high or move higher, at some point they are going to begin recycling those cash flows back into new production and new exploration. It will take time though, but that's the opportunity. So how am I playing it? I believe offshore oil drillers, which are down 80 to 90% from their highs, represent a tremendous opportunity. There are several small and intermediate exploration and production companies, I think, that are positioned in the right plays and that have managements that understand the cyclicality of the oil business and are on the right side of the trend. They represent tremendous opportunity. Those are potential 10 to 20 baggers. And oil field services. These are the companies that provide the services to the oil companies, and as those cash flows are recycled into new exploration and production, we will see those companies react. And they represent tremendous value. Right now they're in the trash bin and nobody wants them. And that, to me, as being a contrarian, means I'm interested, and you should be too. Now, I write a newsletter called the Actionable Intelligence Alert. It's research into contrarian and overlooked sectors, such as what I've just talked about, the oil business and uranium, and select countries around the world that are going from being very bad to less bad. This is premium research and contrarian views. I'm neither a perma-bull or a perma-bear. I let the facts dictate my thinking, and my thinking changes based on the facts. You know, at some point, oil will become overvalued, and it will be time to sell. I'm not a perma-bull on anything, nor am I a perma-bear. We're looking for asymmetric returns in actionable intelligence. I'm trying to turn $1 into $10. There's plenty of people out there who will tell you how to turn $10 into 11. We're looking for big asymmetric moves that are life-changing wealth. I encourage you to take a look at the newsletter. It's actionableintelligencealert.com/subscribe. It's $79 per year for 12 issues, and I offer a money-back guarantee. And in the newsletter, I'm recommending some smaller exploration and production companies along with some service companies that I think that are very overlooked and represent tremendous value. So I encourage you to take a look at the newsletter and take a subscription. Thanks for listening, and we'll talk to you later.